Independent Development Evaluation Function, IDEV. IDEV independently evaluates all aspects of the bank's work. The evidence it generates through its evaluations speaks directly to real development challenges and informs stronger institutional systems, improved delivery, and more effective development financing. The theme of this event is both timely and relevant, as Africa and the broader global community face widening development financing gaps, rising debt pressures, and growing uncertainty. In this context, mobilizing and deploying development finance at scale requires not only increased financial capacity, but also strong institutions, effective implementation, and financial sustainability. Today's discussion draws on IDEV's independent evaluation of the AfDB's commitments under its 7th General Capital Increase, GCI-VII, which was conducted at the request of the bank's Board of Governors. I will present to you some key insights from the evaluation that are relevant to the bank's ongoing reform agenda. After my presentation, there will be a panel discussion on the institutional and financial conditions that enable mobilized development finance to translate into impact at scale. And we will finish with a short question and answer session. So I invite you all to actively engage in today's discussion, and I also take this opportunity to invite you to join us at this year's AfDB Evaluation Week, which will take place from 15 to 17 June. So without further ado, let me pass to the presentation. Next slide, please. Firstly, why does this discussion matter? Africa's development financing needs continue to grow significantly, with estimates of annual financing gaps ranging from $400 billion to $1.3 trillion against the rising debt pressures and shrinking fiscal space. At the same time, multilateral development banks are under increasing pressure not only to mobilize more finance, but to also deliver greater development impact at scale, faster, more effectively, and more sustainably. The global financing and aid landscapes are evolving rapidly. Traditional aid flows are declining, geopolitical fragmentation is reshaping partnerships, and private capital must play a larger role. Yet it remains hard to mobilize in African markets. In this context, the AfDB's 7th General Capital Increase, approved in October 2019, more than doubled the bank's capital base from $93 billion to $208 billion and was paired with 35 reform commitments across 7 objectives. Next slide, please. GCI-VII sought to strengthen the AfDB's ability to deliver development impact through 3 broad dimensions: expanding financial capacity and strengthening resource leverage, improving responsiveness to regional member countries' needs, and strengthening institutional effectiveness and efficiency. IDEV's evaluation assessed the progress made across these dimensions over the 2019-2024 period and identified 3 key insights that I will briefly highlight. Next slide, please. The first key message is that improving responsiveness to regional member countries' needs requires both strategic alignment and strong delivery capacity. The evaluation found that the bank's financing performance recovered strongly following the COVID-19 disruption. ADB window approvals reached 5.7 billion units of account in 2024, meeting the lending target, while non-sovereign approvals increased to 1.74 billion UA, surpassing their target. The bank's strategic alignment with the needs and priorities of RMCs improved, as did its mainstreaming of climate and gender in strategies and operations. However, the evidence also showed that the bank's delivery on the ground was limited by resource and organizational challenges like implementation capacity constraints, financing gaps, and operational limitations. While GCI-VII significantly strengthened the bank's financial and strategic capacity to respond to RMCs, financing alone does not guarantee delivery at scale. Next slide, please. Building on this, the second key message is that institutional readiness plays a critical role in translating finance into timely and sustainable development results. The evaluation found that delivery effectiveness depends on adequate institutional capacity, including staffing, skills, operational resources, and implementation support. The bank made progress through reforms such as decentralization and the one bank approach, which strengthened coordination, local presence, and institutional collaboration. At the same time, operational complexity, coordination challenges, and capacity constraints continue to affect implementation effectiveness in some areas. The evaluation also highlighted the importance of monitoring, supervision, accountability, institutional learning, and sustained reform ownership in supporting long-term effectiveness. The findings suggest that delivery at scale requires adequate resources and capacity, clear roles and responsibilities, effective coordination, and sustained ownership of reforms across the institution. Next slide, please. The third key message is that sustainable development delivery at scale requires strong financial sustainability, resource mobilization, and strategic partnerships. The evaluation found that the financial reforms under GCI-VII strengthened the bank's long-term financial sustainability and reinforced investor confidence, helping to preserve the bank's AAA rating. This enabled it to expand lending while maintaining capital strength. However, development financing needs continue to outpace available resources, particularly in the current global context. The evaluation therefore highlights the increasing importance of innovative financing instruments, private capital mobilization, and strategic partnerships. It underlines that scaling development impact requires not only mobilizing additional resources, but also maintaining financial resilience and institutional credibility to sustain and expand development support. Next slide, please. Overall, the evaluation concludes that scaling development impact requires a combination of financial capacity, institutional readiness, implementation effectiveness, and financial sustainability. The evaluation points to three strategic priorities moving forward: strengthening institutional capacity and implementation readiness, expanding sustainable financing approaches, resource mobilization, and private capital partnerships, and enhancing operational effectiveness, monitoring, and learning. These issues are relevant not only for the African Development Bank, but also for the broader NDB community as institutions continue reflecting on how to deliver development impact at scale in an increasingly constrained and fragmented global environment. Next slide, please. So with that, I would like to thank you for your attention and hand over to my colleague Armand Nezeimana, Director of the AfDB's Development Impact and Results Department, to introduce and lead the discussion with our distinguished panelists. Thank you.
Thank you very much, Karen, for setting the scene. Distinguished guests, colleagues, partners, and friends, welcome to this panel discussion that examines the institutional conditions and financial conditions to translate mobilization of capital to impact at scale. And I think this conversation comes at a very interesting time. Throughout this week, you've been following discussions at strategic level and across these various sites on why it is very critical for the continent to mobilize capital at scale. Today's conversation actually looks at the other side of the coin. So mobilization of capital at scale is critical, yes, but how do we ensure that it translates into impact at scale? So that's the critical question that we would like to examine today. And for this, I'm very pleased to be moderating this conversation. So I'm going to ask our distinguished panel members to join me here on the stage. Let me first start with Mr. Festus Nifenwa. That's my sign that reminds me that I first need to introduce myself. My name is Armand Zeibana, Director for Development Impact and Results, and I'm very, very pleased to have you join us in this conversation. So Mr. Festus Finyenwa, please, if you could join us here, Director for Economic Policy and Advisory Services in the Ministry of Finance of Namibia. Thank you very much for joining us for this conversation. Mr. Omar Sefiani, he's my colleague in the Treasury Department, leading the Treasury Department. So please clap for him because he's the third one, yes. He's the money person at the bank, so you better be nice to him. Mr. Jean-Pierre Fourier, who's the Senior Director for Strategy and Investor Relations at Africa 50, a very close partner of the African Development Bank. And last but certainly not least, my colleague and good friend Malene Bloomberg, the Deputy Director for the Africa North Region Office of the African Development Bank. If you could please join us. Okay. So, perhaps let me start the conversation with the money person, Omar. So, as you've followed the presentation made by Karen, the evaluation report shows that the capital increase of the bank, the 7 capital increase that shifted the bank's capital from 93 billion to 208 billion, resulted in strengthening the financial position of the bank, the financial sustainability of the bank. The prudential ratios are much more robust today than they were back in 2019. So that's very good news. But how do you balance, how does an institution like the African Development Bank balance the need to continuously strengthen its financial sustainability while responding to the needs, the growing financing needs of our regional member countries? How do we strike the right balance in achieving these twin objectives?
Okay, thank you very much. So it is a bit the classic question, right? Technically, we could lend more, right? We could lend a lot more. I mean, obviously, there'll be a trade-off, which is our financial sustainability, our credit rating. But it is a question that's asked quite often, and a question that has come up in the past, I think, 7 or 8 years. Now, although on the face of it, it does seem like a trade-off between, okay, I want to reinforce my financial capacity and I don't want to lend more, and if I do one, I can't do the other. But the reality is the AAA rating, the financial sustainability of the bank, is an important tool for development. So we don't see the AAA as something, as a trophy that we polish each night very carefully, and we're very happy to have just because of the name or the reputation. It is an extremely powerful tool for us to mobilize development finance. And there are quite a few impacts, right, of having this, strong balance sheet and high credit rating. The first one, and it's an obvious one, is the cost of funding. Now, a low cost of funding is extremely beneficial to our clients because we pass on this low cost of funding to our member countries. We only charge, in our sovereign operations, we only charge basically our admin costs plus a small premium for the expected loss. But basically, they do receive, financing at a cost of, our cost of funds, which are roughly, let's say, treasuries plus 5 to 10 basis points, US treasuries, for example, in dollars, plus 5 to 10 basis points, plus about 80 basis points, give or take. So very interesting to have that. Second, we also play a counter-cyclical role. And to play a counter-cyclical role, it is much easier to be highly rated than to be, than to have, let's say, a rating that's not as high. And we've seen this several times. So, for example, in the midst of the COVID crisis, we were able to launch a senior unsecured issuance, and we didn't have any issue to get, the required funding at that time. Now, it would have been a very different situation if the bank itself was perceived as a, maybe not so high quality issuer, right? It's much more difficult to find financing in those cases. So again, another example of why the AAA ratings are important to the institution. So yes, so in a nutshell, we don't really see this as a trade-off. We see this as a condition for us to be able to operate on the continent. And again, there are various different business models. The MDB business model, which is also adopted by some of our peers, is to have a very highly rated institution, low funding costs, ability to act in a counter-cyclical manner, and the ability also to absorb certain shocks, right? We've had, since the GCI was approved, we've had various, let's say, external situations which have impacted the institution and which we have navigated very well. Again, this is thanks to the strength of our financial ratios, but it also tells us something about the necessity to continuously reinforce our risk management framework, the way we take on and manage our risks. You've seen that during the GCI period, there was a request for a financial planning framework, right? What we call the long-term financial sustainability framework. And this framework has been extremely beneficial. Even when I talk to investors, they do like the fact that the bank has a very precise framework to deal with what happens in the markets, what happens in a situation where, for example, you have an external shock. So just for people who don't know our long-term financial sustainability framework, it's built on the concept of projecting our lending over a 10-year period. We make sure that all of our prudential ratios, those that are calculated internally, but also those that are calculated by the rating agencies, remain above the thresholds to guarantee our AAA rating. And in the event, we expect in the future, and this is not something that's happened now, but we project in the future that one of the ratios would fall below the required threshold, we would take action today to resolve it. So well ahead of when it's going to happen. So all of these different items have, of course, improved the ability of the bank, in my view, to deliver on its development mandate.
Thank you. Thank you very much, Omar. I think clearly you've just explained how critical, how important it is for an institution like the African Development Bank to maintain its AAA, passing on the low cost of funding to its client countries. And we've seen the numbers that Karen has displayed on the screen in terms of increased financing capacity over this GCI period. In fact, Karen, you might want to update your slides for private sector operations in 2025, historical level of lending. I think it's important to, again, celebrate the level of financing that we've been able to extend to our client countries. And a good segue, perhaps, for my colleague Malin in North Africa. So you've seen the numbers. We are lending much more, both on the sovereign and the non-sovereign side, to our clients. But how does this translate into greater development impact on the ground? What are the institutional challenges that we are facing, both internally, in terms, I think, the evaluation's findings have pointed to staffing constraint, coordination challenges, but also with our regional member countries represented here today, some challenges in terms of absorption capacity, implementation delays, implementation capacity on the ground. If you could share some insights on some of these challenges and what mechanisms we are putting in place to address these bottlenecks, to really try to accelerate delivery, translate this increased financing capacity into development, effective development results. Over to you, Malin, please.
Yeah, thank you very much, Armand. Indeed, we're very happy about the recent lendings for the last year. Even in a very volatile world, we have delivered more than before. And in a way, I think the African Development Bank, we thrive on challenges in a way. It's not the first time that in adversity we do more than we've expected. But really, when we're talking about the topic, the moving from the capital to the delivery and the capacity constraints you mentioned, I think overall the challenge is that we're all constrained in terms of resources, time, and what this means is all of us in this ecosystem, all of us today and on the panel, we need to focus and prioritize. Only by focusing on what ultimately brings us the greatest results. And I wanted to quickly mention 3 points on this. I wanted to talk about the readiness of the pipeline, the capacity for execution, and the country ownership. So when it comes to pipeline, when Umar does an excellent job in mobilizing financing and increasing, it doesn't automatically turn into investments in the regional member countries because we don't always have enough investment-ready projects. So this capacity, sometimes we wait until last minute and see, there may be funding, should we start preparing a project? And we can easily lose a couple of years in this way if we don't have investment-ready projects. So we really encourage, and where it works really well is when we have seen that we are working upfront with our clients, when there is an existing development strategy with a prioritized list of projects, or a sector strategy that lists the projects. Then as development partners and other stakeholders, we can move together around these priority projects. Even this morning, I was actually having a discussion with one of our member countries about them asking us to help them provide their priority lists. They don't want a development strategy that is high level and a lot of pages. They needed support in defining their development route, what they should focus on first. In Tunisia, we've had a great water sector strategy funded by the African Water Facility and together with the Germans. That's really a best practice that has allowed us to move as development partners together. And in Mauritania, when the government set out to electrify, we stepped up and we were the lead donor in the integrated project for electrification between Mauritania and Mali, and mobilized about $1 billion for this project, with most development partners financing that are here in this week and some more. So just to say that when a project is prepared well up front, we almost always find financing for it. The second point I wanted to make was about the capacity for execution. We could talk at length about the details of the challenges, but I wanted to just step back and from the big picture, I think most governments, I can be told differently from my fellow here, but most governments are not staffed to deliver a large number of investment projects. Yet this is what we're expecting them often to do. So we include a few extra experts here and there and produce some project implementation units, but I think the whole fundamental setup sometimes is not conducive. One of the actions we can do, which we have done in some cases, is using implementing agencies. This can speed up a lot. And I will just give 2 examples. One is for Mauritania, and I keep coming back to these countries as I cover Libya, Mauritania, and Tunisia. For Mauritania, livestock is essential. The country is about livestock. Livestock is more important than cash. and we were asked to prepare a livestock program. Now, what we had on the ground, we had connections then with FAO of the UN system. They are experts on this, and they're very good at preparing programs. So we entered into tripartite project preparation agreement with the government and FAO, and they delivered within 1 year. We had the program studies. We saved more than a year by not having to do a grant directly with the government, who would then recruit a consultant after having set up a PIU. So now we had a project prepared very quickly by people who know the details on the ground. We funded the first project under this program, and other development partners are coming on now. So this is just an example. In Libya, we also use implementation agencies quite frequently, which has been very effective. They're often UN agencies supervised by government. It gives very quick results, very high quality of knowledgeable people. But not every country, and it's not always preferred to do an implementing agency. But I think still there is an opportunity to pull together some core competencies at central government level. We often struggle to get procurement experts for each project, yet it's critical to the startup and implementation. We often struggle to get sufficient environmental and social safeguards experts. They're limited in the countries. And all projects don't need them constantly at the same workload, yet we have them there full-time afterwards. So these are areas where we could have pooled resources at the central level, working with a number of projects in the portfolio, making better use of the expertise that we have. Finally, I wanted then to talk about the ownership. Really, the number one thing a country can do to help us, help you bigger, greater, faster, is really to have the priorities known, to own and know what you want in terms of priorities. This helps us together work on the priorities. It helps us best use the different types of instruments. When we know what the country wants, what the big picture is of the pipeline, we can then allocate where, together with the government, where should national funding, public funding go? Where should private sector go? Where should guarantees? When do we need to call Africa 50? Because we know that there's an equity component that can be provided. I want to mention the example of Egypt in this case. Egypt has a large-scale coordination platform that's called NAUFI, the Nexus for Water, Energy, and Food. I'm not sure if it's that order. So for these three sectors and the Nexus, so it's it was the Ministry of International Cooperation that has recently changed now, who has led this and asked one development partner for each sector to lead. The African Development Bank has been leading the water sector, EBRD Energy, and IFAD has led the agriculture part. Together, this has created an integrated pipeline and mobilized $10 billion. So this really shows how together, by working together, you remove transaction costs, you remove redundancies. But it's the government here who stepped up and did the heavy lifting and coordination. So really, I wanted to end with this, that we can do a lot, but we have to work a lot more on these questions of delivery. And I'm very happy that this week we've been talking about mobilizing greater amounts of financing, but if we want impact on the ground, we need to put the same energy and the same amount of talking about the delivery, how we deliver. So maybe next annual meeting, who knows, maybe we'll talk about the delivery in the same energy and enthusiasm as we talk about mobilizing financing this week.
Excellent. Thank you very much, Marlene. I think you've just found the theme of the next annual meetings. Yeah, so excellent examples, tangible examples of how to enhance implementation capacity through partnership on the ground, through coordination with other development partners. Excellent. And I think it's only fair that we now take the same question, but from the view of the client country. In Namibia, Mr. Festus, sitting from the Ministry of Finance in Namibia, how do you see these implementation capacity challenges, absorbing these additional resources from the African Development Bank, but other development partners as well? What are the governance, political, institutional arrangements that you see to really unlock these capacity constraints that delay implementation of projects and that create these bottlenecks? From your perspective, please. Thank you.
Yeah, thank you very much. And I'm happy to be here and share the experience from Namibia. Perhaps just as a way of background, Namibia joined the African Development Bank at independence. We have gained our independence in 1990, but we have started with our active engagement on the bank's operation in 2005. We have started only with a portfolio of 34 million US dollars that was aimed, to assist with the development of our agricultural sector. So today, the portfolio of the African Development Bank with Namibia has increased significantly, standing at around 889 million US dollars. So our engagement with the African Development Bank is guided by the country strategy paper. The current one is active for the period 2025 to 2030. The aim of this is for the development of infrastructures, economic management and governance, and then human capital development. Yes, of course, we all agree that the general capital increase of the bank was a bold step to increase the capacity of the bank, to be able to respond to the needs of the regional members. But I think when you look at the findings of the IDEV independent evaluation, obviously, you will realize that the success is not only measured by the size of the resources, but the way that resources is deployed and the impact it's making on the ground. Yeah, so there are some ingredients, that make, the delivery at scale possible. One of those ingredients is stability, both political and economic. So Namibia is a multi-party democracy with consistent political stabilities. We hold our elections every 5 years, and the maximum the president can stay in the office is only 10 years. You are only allowed to, you are elected for 5 years, and you are only allowed to seek the second term, and that's it. You had to go and give somebody else. I think, that stability, created uncertainty, created certainty, and also, the credibility, of the country, and, to engage with our international partners, including the African Development Bank. And I think in terms of the second one, I think it's, the credible governance and credible governance framework and accountability. So it's very important. Namibia has developed an anti-corruption framework and accountability system, which really, provides the assurance, to the investors, and make it possible, for the, financial flows into the country. I think the other perhaps component is alignment, policy alignment. And as I have indicated, we have a, country, or rather, country strategy paper, which is guiding the engagement, between Namibia and the African Development Bank. And, this country strategy paper is aligned, to our country's Vision 2030, our National Development Plan, and also somehow aligned to the AU Agenda 2063. So those are the frameworks, that made it possible, for you to engage and, create confidence, in your partners. what is important again is institutional framework. Of course, out of the 889 million US dollar portfolio, 61% is sovereign, and then about 39% is non-sovereign, including private partners, private sectors. But of course, there is still a need for us to do more, to include more private sector, to bring more private sector on board. Because, that 39% component is, shared between the public enterprises and then private sector. So, yeah, I think for the sovereign component, it's managed through the interinstitutional, coordination, where the Ministry of Finance, as a contact point for the African Development Bank, play a coordinating role, working with, implementing agencies and ministries. Makes it possible, for us to trade with the rest of Africa, especially, under the African Continental Free Trade areas. So, and then in terms of energy, we have also deployed resources, to the energy infrastructure. And this is not only, internal infrastructures, but we are also connecting with our neighbors. Namibia is a semi-arid country. It's a very dry country. So we don't have, water, running, within our country. We don't have any river. The only rivers that are available are in the borders with our neighbors. So the power that we generate, it's not sufficient to meet the demand. So we import electricity from our neighbors. But we have relatively advanced, transmission infrastructures. And therefore, one of the bigger projects that we are undertaking is, Namibia-Angola transmission infrastructure. You know, some of the challenges, including the human capital. Yeah, and that's also linked to institutional framework, because in most cases, you know, we don't have, you know, dedicated project management office, you know, but then that role is played by, you know, officials that are assigned to that assignment while they also have, you know, other responsibilities. And therefore, you know, sometimes it causes delays. Yeah, so, and then the other, you know, you know, to play the role, you know, in the, you know, also with the domestic resource mobilization. So our institutional investors, you know, have an asset base of about 182% of our GDP. So, and out of that, 42% by statutory should be invested in the country, while the rest, you know, can find investment home anywhere, you know, where they can. Thank you.
Excellent. Excellent. Thank you very much, Festus. I think you've given us a lot of insights on the critical success factors to really translate increased financing capacity to development impact. Very strong governance institutions. You've mentioned institutional framework, policy coherence, coordination from the Ministry of Finance, the very important partnership with the private sector, and very interesting insights into the strength of the private sector in Namibia that the government can leverage on to really drive development impact in the country. I very much like the passionate vision that you described about the potential with the you call it the transport corridor. We've now shifted our language into development corridors from Walvis Bay, where the bank has been an active investor and is looking at opportunities for expanding that asset and growing that infrastructure and that throughout that corridor, along with the investment we're doing on the other side of the continent with Lobito, which is also generating a lot of excitement as well from investors and from the bank. So very exciting insights that you're providing. So I'd like now to turn to Jean-Pierre from Africa 50. You've heard Marlene, who's mentioned some of the challenges we have with the quality and the readiness of our pipeline. So Africa 50 is a very, very important player in project development, infrastructure project development. So I'd like to hear more about how you see that the partnership with the bank, but with other players as well, in terms of driving development impacts on the continent. How do you see, where do you see the bottlenecks? Where do you see the success factors in terms of partnership models, mobilization models that work? You've heard throughout this week about how we want to scale up mobilization. This cannot happen without players such as the African Development Bank, Africa 50, and others to work together in synergy. So I'd like to hear more about what's your perspective on this. How do you see us really rising to the challenge laid out by President Sidi Uta. Thank you.
Thank you, and thank you very much for the opportunity to give a real-life example of some of this additional capital that has been deployed through what we would like to think as Africa 50 was birthed by the AfDB, an instrument of your strategy. It's okay?
Yes.
Better? Thank you. So, yes, as I was saying, Africa 50 was birthed by the AfDB, and we think we are an effective tool in terms of some of the capital that you've allocated towards us. Africa 50 addresses some of the concerns raised here, which is an important part of the conveyor belt of projects, where we play an early funding role in equity financing of early stage project development. So bringing a project such as we did in Senegal, 125 megawatt power plant in Malikunda, which started as a blank sheet of paper, and 4 years later, we're developing or generating electrons onto the grid. So we've got a definite capability of developing and de-risking projects by providing equity. And that is through the capabilities provided to us from a financial point of view from not only the AfDB, but the 33 other countries that are our shareholders. And I think that's probably the biggest part of the equation to, and Million alludes to it, it's the biggest part of the equation to be able to solve, is the amount of time that it takes a project to get to bankability, the amount of regulatory frameworks, environmental assessments, etc., but also the capability to evaluate those risks and then provide some type of mitigation, which is a key part of what we do. It's also an instrument that the AfDB has, and we partner a lot with CEFA, that is doing similar type of work, early stage project preparation and project development. So that would be one example of the utilization or partnership with an MDB. Another example would be the opportunity for private capital, and I give this as an example because it's not only us that have done it, but there are other opportunities around where we securitized some loans from the AfDB in a concept called Room to Run, where it was the first MDB securitization program run on the African continent, and provided some liquidity to the AfDB and obviously made some return on that, and were able to attract capital. The last part that I'll mention, which I think is something that it was our key agenda here at the annual meetings, was to drive a concept called asset recycling, where through an instrument which we are able to provide, we are able to give governments access to capital for some of the assets that they own and manage, and don't necessarily need to be the owners of, be that a toll road or a bridge or a power plant, etc., even a port, where we would present value the cash flows of those businesses, work with the government to finance that, and in essence concession out that asset to ourselves, crowd in additional capital. It allows the government then to receive upfront payment, utilize that capital to either pay down the debt or invest into another infrastructure project, and we manage and maintain and operate that specific asset over a period of time and then return it to the government. So those would be some of the structures that we've worked with not only the AfDB but a number of other MDBs to begin to implement. And that's a smart way to begin to deliver a larger amount of impact. At the end of the day, Africa 50, through our 33 projects that we've invested over the last 10 years, has made some significant impact, and our intention is to scale and grow that over time, in partnership with not only the AfDB, but a number of other MDBs. So those would be the 3 points I would make.
Excellent. Thank you. Thank you very much, Jean-Pierre. I think these are excellent initiatives, examples of partnership initiatives and instruments and tools to really mobilize resources and put them to use for development impact. Excellent. I like the point you made about about de-risking projects through project development. Because we've been discussing about mobilizing private capital resources, private capital money for development. The first step for de-risking is having bankable projects. So bringing projects to bankability. That's the most important aspect of de-risking investment on the continent, and this is a major bottleneck. So we need more of such partnership with Africa 50. You've mentioned CEFA, AGIA as well in the energy sector. Very, very critical role. We need to have more resources invested in project development, in early stage project preparation. And I like the point you made as well about asset recycling. There's a lot of excitement around this that will be able to relieve sovereign debt and be able to reinvest for investments, yes. So I see that we're running slightly behind time, but we still have a bit of time, 10 minutes. So perhaps we can take a few questions from the audience before we close this very interesting conversation. I hope some of the insights shared by our panel has generated some questions or comments from the audience. So anyone? Yes, thank you for breaking the ice. Yes, please. Can we have someone? Thank you.
Thank you, and thanks a lot for your excellent presentations and intervention. My name is Hilda. I'm the temporary governor for Sweden to the AfDB here today. Great to be here. And I came especially to listen to the independent evaluators of the GCI-VII commitments. Apart from contributing to the capital increase, Sweden is the only shareholder that 4 times has put up extra callable capital for the bank.
Absolutely.
For those of you who are not into this lingo, thank you. For those of you who are not into this lingo, it means that should things go bad for the bank, we have some major guarantees. So Swedish taxpayers have put out major guarantees to cover the bank, which we will hopefully never have to use, but I think it contributes a little to what you were talking about, this AAA. So one of the things we realize that we know, that we follow up on a 6-month basis is how the bank is moving towards getting a standalone AAA, so that you can have a AAA that is not so dependent on those countries that have our own AAA status. And it's not a secret that there is economic turmoil in the world today, and maybe there will be some more downgrades of those few AAA countries. So I'd like to hear something about that.
Thank you. We'll take a second question before we respond. The gentleman in the middle, yes, and then we'll come back to you later.
Thank you very much, Mr. Moderator. Just a question too, I hope I've got the name correct, Malian.
Excuse me, could you present yourself, please?
Oh, sorry. I just followed your example. Elias Mahosi from SADC, South African Development Community. When you said you are looking for a project that is prepared well, what does well look like? And what are the key features of a project that is really, really well prepared? And secondly, the one goes to Africa 50. To what extent do you look at providing funding for early stages of a project, and what is the horizon for these stages of a project? Thank you.
Great. I think we have 2 excellent questions. The first one, no, I think we'll take 2 and then the next round. First of all, many thanks to Sweden for very, very strong supporter of both the African Development Bank and the African Development Fund. And I think Omar will take on this first question, and perhaps Jean-Pierre will take on the second question about project development. What does well-prepared project looks like, if you could, and explain a bit the process to reach projects to bankability? Thank you. Omar, over to you.
Yeah, but now you
Okay.
assigned it to you.
Thank you very much, and again, many thanks for Sweden's steadfast commitment to the African Development Bank. It is obviously very well appreciated. I actually worked on the general callable capital increase, so I feel almost personally responsible for ensuring that the bank does attain the standalone AAA credit profile. And just maybe to give a bit of context to everyone. So for a period of time, right, the bank has been relying on, shareholder support. And, shareholder support is measured different ways by credit rating agencies. But it was relying on shareholder support in order to be able to extend itself a bit more and provide more lending to its clients. But over time, the problem has been that the rating of our shareholders has been decreasing, right? And especially the rating of our AAA shareholders has been decreasing, and we've had a number of downgrades. I'm not going to mention the countries by name, but I'm sure you'll be able to find them through research. Now, the problem with that is that it puts us in a very difficult situation, and this is, when I mentioned external factors, this is typically an external factor that can impact the bank and have consequences on the institution if not well managed. So we did this general callable capital increase, and one of the the agreement with the board was that in order to solve the situation on a, let's call it permanent basis, we would attain a standalone AAA credit profile, in which case we would reduce the dependency of the bank's credit rating to, a AAA, to our shareholders' rating, and in particular to AAA shareholders. Work has been ongoing on that. Our standalone AAA credit profile, and now I'm going to talk specifically on Fitch. Moody's, we already have a AAA standalone credit profile, so we're already good. Fitch, when we had initially the discussion, we had a standalone credit profile of AA-, and over the years, we've been improving the ratios of the bank, and we've moved from AA- to AA to AA+. So we're sort of, I would call it two-thirds of the way from attaining a standalone AAA credit profile from Fitch. There is still a bit of work to be done. A couple of things that are important for Fitch are, for example, the credit profile of the loan portfolio. Now, obviously, we operate in a continent where, of course, the credit profile of the countries that we operate in is what it is, right? This is an external factor. We have to deal with it. So we've been finding ways to try and optimize the situation, and we have a number of tools that can be used. So, for example, balance sheet optimization. We can credit enhance the profile of our portfolio. So work is in progress when it comes to this item. Let's say that the Fitch ratio, the one that is specifically responsible for this issue, and just to give maybe the audience a bit more context, the specific Fitch ratio that is responsible for this is what we call the AAA callable capital to net debt ratio. And Fitch has the methodology whereby shareholder support, and especially shareholder support to attain a AAA rating, if you're not, of course, on a standalone basis, requires you to hold enough AAA callable capital to cover your net debt. So net debt obviously increases as you increase lending, and this creates some tension with the lending. So on the one hand, we are working on this standalone AAA credit profile, and like I said, we've made good progress and continue to make progress on it. We're very committed to getting there, but we also have some other solutions that we're working on which allow us to enhance the callable capital of the institution. Now, for those who know, the G20 Capital Adequacy Framework report, there were a number of recommendations in there. Recommendation 2A, for those who've read the report, encourages MDBs to look into enhancing or better utilizing, let's say, callable capital. And so we're also working on that. So we're also working on solutions that would allow us to uplift the quality of the callable capital that we receive. So that's still work in progress, but just to say, we are moving towards the desired goal, and we do have various options to get there. Thank you.
Sure. So to answer on what does a good project look like, it's a pretty complex question, and there are many facets to answer, but maybe you start with the end in mind. We'd be remiss in this forum not to think about, well, what impacts is this project going to deliver at the end? What type of financial institutions would be willing to provide debt to this project? How realistic is the sponsor being in terms of the timeline to development? How have they approached the various risks in the project? Be that the off-taker or the resource risk, any type of environmental or social governance issues, how have they been mitigated? So those would be all elements that one would have to consider. You would also consider the viability of the sponsor, because project development takes longer than you would expect most times, and many projects fail simply because the sponsor runs out of runway. That might be mental runway as well as capital runway in a way. So those would be 4 or 5 things that you would have to bear in mind, but there's a very long laundry list of aspects that one would consider. I'll add one more, which is the strategic importance of that project, specifically if you're dealing with a sovereign off-taker and that, so the government backing of a project would also be very important. Malene, you might want to add.
Yeah, so for me, a well-prepared project is, first of all, there's a couple of components that we look for. First, are the technical studies there? Usually, this is usually the case. They're usually there, sufficiently detailed. The next is the environmental and social studies. They're often not quite at the level that we need. And this often delays because someone needs to find the financing to add on these studies to be at the right level. Because we realize with stakeholders, we don't always have the same view on what is sufficient, resettlement action plans, these kind of things. So that can easily delay by a year or so, actually, if we don't find the financing easily together. So this is really the basics. And that is for all projects. The next thing we need for a well-prepared project is, has it been structured? Meaning, now we go to who is going to finance this project. So in this case, we can say, if it's a straightforward public sector project, and it's a loan from ADB, the structuring is very simple. We take those technical studies and environmental studies, and we provide a loan, and it gets implemented. If it's a public-private partnership instead, where exactly, as we heard, you have to allocate the risks, you have to decide who is financing what, on what terms, the structuring can take even longer than the technical studies. So this really then depends. So there we're into something that's much more challenging. And I'll give an example where we tried to do it in parallel. In Tunisia, we're supporting the preparation of a metro, or an above-ground metro of the second largest city, Sfax. And we're using a grant from the Urban Development Municipal Fund to do the technical studies. And in parallel, the African Legal Support Facility, who have been here this week, they are doing the structuring of that deal as a PPP. And we're running them in parallel, the 2 strands, to make it as quick as possible for the government for whom this is a priority project. Thank you.
Thank you very much. And I very much like the expression used by Jean-Pierre, running out of runway during project development. So you have institutions here that help you not run out of runway. So we have time for a very last question by the gentleman here in the middle, and then unfortunately we'll have to wrap up. Apparently there's another event taking place here. So please, sir.
All right, thank you very much, and thanks to the lead speaker. We'll be talking about capital mobilization. We know that one very key enabler is the ratings. Ratings very key to how much we can mobilize and what the cost will be. So my question is this, maybe to our friend from Namibia. Do you think these foreign agents, rating agencies have been fair to Africa in their ratings? Are they fair to Africa? Because we understand that Africa pay higher than other regions. When it comes to debt servicing, Africa hardly defaults. Thank you.
Yes, so a very topical issue. Rating agencies, are they fair to African states? Is the rating fair, basically? If you have a view on this, I'm sure you do.
Yeah, I mean, thank you very much. Well, I think the question whether the rating actions by the rating agents are fair or not fair, I think it depends on where you stand. Namibia is rated by two rating agencies, that's Fitch and Moody. And we have been, working with these rating agencies for quite some time now. And I think it has been beneficial to the country because it provides, assurance, to the investors, that it's really worth, to invest in the country. But of course, there has been public views and, also at the regional level, that, the rating actions may not be fair, but I think the answer lies, where, one stands. So I don't have a direct answer whether I say yes, it's fair or it's not fair. But I think there are more ingredients that are that are required for country to make impacts in terms of investment attraction of investment and also in terms of access to the lending market. So Namibia, like I have indicated, we have institutional investors with an asset of 182% of our GDP. So liquidity is not a problem in Namibia. At the moment, about 90% or about 89% of our, total government debts are domestic. We have just, and that is because we have also just, redeemed our Euro bond in October last year of $750 million US. But when it comes to the market, we have relatively well-developed, financial money and capital market in the country, and the liquidity is really sufficient to finance the government's deficit. But of course, we want also to be fair as a government. We don't want to, squeeze our private sectors because we know that our private sectors also need this money. But like I have indicated, out of that 182% of GDP institutional, only 45%, that's compulsory by statutory to be invested in the country. So 55%, they are floating around, and we have also free capital mobilities, capital movements, with South Africa, the bigger and more advanced economy in the Southern Africa, because we are in a currency arrangement, so you see that there is always movement of capital, flowing from Namibia, to South Africa, through South Africa, and into the international market. So, but I think, it really depends, fair or not fair, it depends on where you stand. Thank you.
Thank you. Thank you very much for this very balanced response. I think this concludes a very interesting conversation that really underscores that mobilizing finance is critical for the continent, but it's not sufficient. We also need effective delivery systems. We need strong institutions. We need strong country ownership. We need strategic partnerships. We need innovation as well. We've mentioned a number of interesting, innovative approaches taken by our institutions to raise more resources, but also deploy these resources for the benefit of development progress onto the continent. So I'd like to, if you could please join me in thanking the outstanding panel we had today for this discussion. Thank you. Thank you very much. Malin, Jean-Pierre, Omar, Festus, thank you very much for your insights and your contributions to this conversation. And I'd like to thank you as well, the audience, for taking part in this conversation, and wishing you a very nice evening. Thank you. Thank you, Karen. And your team. Always.